And there we go, guys. Thank you for attending tonight. So I just wanted to take a minute to say good evening to everybody. Thank you for joining us. As you may know, my name is Carol Foderick from the Carol Foderick Real Estate Group here at Keller Williams. We are here tonight to talk about the ins and outs of being a first-time buyer in this market in 2024. What does that mean to you? Tonight's seminar is going to be all about navigating this market as a first-time buyer. And it is our most recent addition to our education calendar. In January, you guys might remember we gathered digitally to discuss the current state of the mortgage market for people who are already in mortgages. And in February, we hosted an event talking all about family law. That was super fun. We just discussed divorce for like 2 hours. It was very informative. Our next seminar in July is going to be about everything you need to know wills and estates. That one is super popular and one you should all definitely attend. And as you may know, we host these workshops that because we believe that by providing our clients with the most accurate, fact-based, and up-to-date information, not only about real estate, but really just everything that affects your financial well-being, it's just one more way that we can be of service to you guys as our clients, both before, during, and hopefully after we're able to meet your real estate needs. But if you're joining us for the first time tonight, welcome, welcome, welcome. There is so much to unpack with this topic this evening, and we're going to get into it. There's going to be an opportunity for you guys to ask questions at the end. And of course, as you can see, I am joined tonight by Omair Amir from Mortgage Architects. Omair is one of the lenders that we work with alongside to serve many of our first-time buyer clients, and he's going to combine his experience with ours tonight and hopefully answer a lot of your questions and give you a clearer picture of next steps forward to get started on the search for a home if you feel that you're ready to do that by the end of this call. Just a couple of things to note. This is a webinar, so all the mics are going to be muted, and you can use the chat function at the bottom of the screen to ask questions. If you have a confidential question that you'd like to ask, you can do so by just putting it directly to myself or just the panelists instead of the open group chat. This presentation is going to be recorded. We're in the process of recording it now, and you'll be receiving a link to watch it later, probably within about a day. You're also going to be receiving a follow-up call from the agent from the Carol Foderick Real Estate Group that invited you here probably in the next couple of days, just to make sure that you got all of your questions answered. And of course, please feel free to share this recording with anybody you feel could benefit from this information. This isn't something that's taught in school, guys. You know, unless you take the initiative to show up to a webinar like this, there's a lot of information that just doesn't get shared. That I think is going to be really valuable. As you may know, our real estate group works primarily by referral, which means that instead of investing in, say, conventional advertising, we choose instead to invest our resources into providing just an exceptional customer service experience for our future and current clients. And just by continuing to show up in service to all of our past clients. We are a group of 32 real estate professionals, including 17 full-time agents, all working towards a goal of making your transaction as easy, financially beneficial, and enjoyable for you as it possibly can be. It's just one of the reasons that, you know, we're ranked among the most successful teams in the country. And I do hope that we will have the opportunity to work with each and every one of you to fulfill your dreams of home ownership. We are just so excited for the chance to exceed your expectations. So without further ado, let's get started. I'm going to turn this presentation over to Omair. Remember, questions and answers at the end, and then we're also going to be sharing some real listings that you can buy today. So stay tuned for that. And then our IKEA gift card giveaway at the end as well for someone who stays on right to the very end. So Omair, I turn it over to you, and I'm going to mute myself and you can share your screen.
Okay, awesome. So I will share my screen now. Okay. Just give me a thumbs up if you see my screen.
We'll get into full screen mode. You're going to share your full screen, and
yeah, you see it?
We can see it. Thank you so much.
Okay, awesome. Okay, well, first and foremost, thank you for having me. You know, it's a pleasure to be here and and talk to you guys about the first-time homebuyers presentation. Okay, so I guess first and foremost, I'll introduce myself. My name is Omair. I am a mortgage broker out of Toronto. I service primarily the GTA market. I've been doing this for about 15 years. And my mortgage brokerage, the Six Mortgage Group, we're top 1% in the country. and we have about 35 agents, and this is our primary job. So today, essentially, is we're going to talk a lot about first-time homebuyers and getting into the market. So the most important thing, right? I believe that knowledge is power. And I've been in this industry for over 15 years. In that 15 years, I've had the pleasure of assisting thousands of families with their home ownership goals. I funded over $2 billion in mortgages. And really, none of this changes, right? These conversations are something that we're having on a daily basis with our clients. We're educating them about if they should be buying or if it's better for them to continue renting, answering all these questions. And today we're going to focus on this a little bit, and we'll try to provide you with some answers to questions that you may have had about home ownership. So before anything else, I just always like to put it out there, what's the reason that we're buying real estate? Why are we buying real estate? And in almost all of the occasions, right, the answers usually are very, very similar, right? It's that, you're looking for that sense of security that comes with, home ownership from your own home. There's also that pride of ownership, having your own place. It's also about, a place to raise your family. But then there's also the reason that you want to generate wealth. And that's also very real, right? We know that real estate can lead to generating, generational wealth if it's done right. And it is on everyone's mind. So we will discuss that a little bit in detail as well today. This was an article that came out a little while ago. It was on the Financial Post. I found it very interesting, so I wanted to just put it out there. The Financial Post, it was actually TD that did the report, and they looked at renters versus homeowners. And what they said was that wealth is no longer about rich versus poor. It's more about homeowners versus renters. So what is the summary? Essentially, what this report said was that the average net worth of a homeowner was around $1.4 million. And the average net worth of a non-homeowner or renter was about $200,000. So there's a significant discrepancy here between the net worth of a homeowner versus renter. So why is that? So this is what kind of we're going to explore a little bit and put it out there for you guys.
Can I ask a quick question, Omair? Because I love this. I love this stat, but it's often taken out of context because I know some of you guys on the call, either watching live or later, will look at this and say, well, I don't have $1.4 million, so I can't be a homeowner. And I'm a renter and I certainly don't have 200,000. I think it's really important to sort of frame this through the context of this is looking at homeowners versus renters after a period of time. So this might be a 10-year projection. This might be a 20-year projection. This may be a retirement age projection. But I think the difference is that, we have a situation where housing isn't a discretionary expense. Everybody has to pay for the roof over their home, over their heads, and the home that they live in. The difference is that some people are paying themselves to live there, and some people are paying a landlord who in turn is paying a mortgage. So, most renters in the GTA are already paying a mortgage. It's just unfortunately not their own. And I think it just speaks to the fundamental, right, that everybody should have the ability to own the roof over their head. I believe that strongly. I know you do too, Omair. But when you read this, I think it can give a skewed impression that you have to be wealthy to get into the market, or you have to have come from generational wealth to get into the market. And I know you're going to talk about that a little bit on, but I just want to, maybe make that comment. Yeah. Is that a true statement, Omair?
Yeah, no, you're absolutely right. And also, I think this study was over 25 years.
25 years.
Yeah, no, you're absolutely right. Yeah.
Long-term projection. Yeah.
It's long-term projection, and the whole point of the study here was to see who was coming out ahead, right? Was it homeowners or was it renters, right? And that's what they realized, that within the period of 25 years, people that were investing into home ownership were coming out $1.2 million ahead on average. And obviously they look at a sample size just like any other study, right? But it's still, the numbers are significant, right? And you can't ignore them. So let's talk about it. Why is this happening? So again, from the same article, the average net worth of a homeowner is approximately 85.71% higher than that of a non-homeowner. And there's a reason for that. And you'll see it as we go forward in our presentation today. So, there's Vincent Vega here, and really the question is, are we too late to the party? Because that's the question that I get asked all the time, right? Prices are so high. Can we even still get into the market? Is there even a point to get into the market now, since prices are so high? Well, I think it is. So I think you're not late to the party. I think the prices will continue to go up. And here's the reason why, right? The first and foremost is that the economic vital immigration will continue. So what that means is that we're welcoming people into our country, into Canada, and they're vital to our immigration. And again, as more people come in, more housing need is required, plain and simple. Supply and demand. This is the main reason why prices are exactly where they are, right? When there's one home for 30 families out there, what you're going to see is you're going to see multiple offers. You're going to see people bid up prices. The reality is that there's just not enough shelter. There's just not enough housing. And it could be because of poor planning. It could be because of a lot of the restrictions with municipal land development. It could be because of the taxation issues, so on and so forth. Something that we cannot solve today. Urbanization of metropolitan cities, that's also a factor. And again, you've heard about international students. We're taking a lot of people that are coming in, and rental demand is also going up. So when people are coming in and they're renting properties, someone needs to have those properties. Someone needs to buy those properties, right? So we're going to look at that a little bit in more detail. So let's talk about immigration a little bit for one, right? So last year, the target for immigration was about 500,000. We welcomed 1.2 million people to Canada in 2023. It's a record, right? We continue to bring in a lot of immigrants, and that is the backbone of our economy. And it's not going to end today, nor anytime soon. So while this is happening, in 2023, we built 223,000 new properties or new homes, which is actually a drop from 2022. We were down 7%. On average in Canada, over the last 10 years, we've been building close to 250,000 new homes. It's just not enough, especially with the amount of people that are coming into our country. CMHC, the Canada Mortgage and Housing Corporation, they said that by 2030, we will need 5.8 million homes. We're no way close to that. With the way what we're building right now, it will take us 30 years to be even close to this mark. So what's going to happen? Well, same thing. Demand is going to be way more than supply, which will continue to push prices up.
Omair, I'd love to just chat about that for a minute, because this is something we see acutely from a real estate point of view. There has been a lot of talk in the media about the need to build housing and the need to be able to, accommodate all the people that are coming into the country. Two things that I'll just note, because the conversation about immigration is certainly a controversial one. But what you need to know is that the vast majority of people that are coming in as economic immigrants, which means that they are coming with substantial amounts of wealth with them. And although there are some preclusions about when they can enter the real estate market, and I think we're going to touch on that a little bit later in the presentation, the vast majority of them will become homeowners in this marketplace. Almost all of them, with a handful of some that will settle in on the West Coast, and a few that will settle in French-speaking Quebec, because they are French-speaking. The vast majority of them will settle in the GTA. And I think just anecdotally, all of us that live in the GTA feel that already. And so that's what is creating this huge amount of pressure on our rental market, the immigration and then also the international students. This is a really interesting statistic because the need for, $5.8 million homes, 5.8 million new homes to be built. The challenge on the construction industry side is that we don't have the labor force to be able to build that fast. We know that one of the largest builders in Canada is Minto. Some of you may even live in a Minto building. This is a condo builder. They, in a good year, will turn over about 2,000 units to the marketplace. That's the largest home builder in Ontario. We don't have the labor force to be able to build this fast. We just don't, it just doesn't exist. So I know that there's been a lot of talk in the media about, oh, we can build 150,000 new homes a year. That is simply factually incorrect. And it's something that I think everyone in this call needs to know, because those of us that work in this industry see this coming storm of the housing cyclone that's going to hit us with this perfect storm of just huge amounts of demand, huge lack of supply, lack of urban planning, and lack of available space to be able to continue to build at this rate. So thank you for sharing this. But I think everyone on this call will agree that 5.8 million homes being built in the next 6 years is simply a logistical impossibility for us.
Yeah, it's not going to happen, right? Which further exacerbates the crunch between supply and demand, right? Okay, and then that's just the immigrants that are coming over to our country. The one thing that CMHC, or really nobody, has any data on is formation. So when we talk about formation, we are talking about household formation. This could be two individuals that get together, become a couple, and now they want to raise a family, and their shelter needs change. Or it could be when a young adult decides to move out of their parents' house. It could also, like, formation can also be decoupling of a couple, right? Then their household needs will also change. And then obviously, there's the life stage factor where someone may need to downsize. So a lot of this formation data, CMHC does not keep track of. But this also impacts demand and supply, because this doesn't change, right? There's always a need for housing. And plain and simple, supply will just not be able to meet demand. Not anytime soon, not in the next 30 years. And what else is happening? Well, the other thing that's happening is interest rates. Over the last couple of years, we've had an environment where interest rates have been pretty high. We know exactly why that is. Inflation was over 8%, 2 years ago. Bank of Canada went to war with inflation. And the way they do that is by raising interest rates. They did that, and now it seems like inflation is close to what Bank of Canada deems acceptable, right? The target inflation is 2%. We're getting very close to that. And that's where the expectation comes in that rates will start going down. So what happens when rates start coming down? Well, we already have a lack of supply. So when rates go down, market sentiment heats up, demand goes wild again. Guess what happens? That multiple offer situation comes back. Actually, Carol, you're probably seeing it. It's already back, right? Since we've seen fixed rates go down over the last few months, we're seeing multiple offers on pretty much every property that we're seeing right now. And that, again, drives up prices.
Can I ask a question, Amir? Because I think that's a big misconception, and one that's probably shared by a lot of people, even real estate professionals. I've heard so often, I'll think about buying when rates start to come down. The reality is that rates have been coming down. The rates that a buyer is paying to the bank have been coming down. Can you speak to that? Because I think it's a big misconception that they're still high and then they're going to drop at some point. Rates have been decreasing. How long and why is that happening, Omair? Because I think that's going to be helpful for the people on this call.
100%. So what you have to understand is that there's, when you look at interest rates, there are two types of rates. There's the variable rate that's controlled by the Bank of Canada. And then there's the fixed rates, which is controlled by the bond markets. So what's happened is that when Bank of Canada increases their rates or decrease their rates, that's when the variable rates go down. And variable rates, you could have a variable rate on your mortgage, on your line of credits, loans, whatever have you. But fixed rates are based on bond yields, and bond market reacts to market news, as if you were. So market news and market expectation drives bond yields up or down. So the fact that the fact that inflation has been coming down, bond markets anticipate that interest rates will go down over the next 24 months. And with that expectation, bond yields have come down. Because of bond yields coming down, fixed rate mortgages have come down. So we've seen a decrease of close to 1.5% on fixed rate mortgages since January of this year. And actually, we saw another rate decrease by a major bank, Scotiabank, this morning, today. And that's, again, because last week the CPI, the inflation report came out, and it was well below what everyone was expecting. So a lot of this is sentiment alone, right? And that sentiment dictates Bank of Canada and the bond markets. So we are already seeing rates go down. We're seeing rates as low as 4.74. 4.69 for a 3-year fix, and it is becoming a catalyst for activity in the market. Does that make sense?
It does, yes. I think most of us understood about 20% of what you said, and the rest was like legalese and mortgage jargon. But I think it's important to note that, yes, interest rates have come down on fixed rate products already, which is why we're seeing this surge in the marketplace. So 2 comments I'll make, because we see it from the other side. Everything that we have listed as a real estate group, and we represent a geographic area that spans most of southern Ontario. So listings all the way from Hamilton in the east, Barrie to the north, and Hamilton to the west, Barrie to the north, and Bowmanville to the east is our general trading area within our real estate group. And we have not launched a single listing, with the exception of one, since January, that is not sold in a multiple offer situation. So it is rapidly turning back into a seller's market. And I don't say that to cause alarm among the people here, because there's always going to be good deals to be found in the market. But I think it's important to know that the winds are shifting. This 2-year period, we've come down where buyers were very much in control of the process. I think those winds are shifting a little bit. We're not in full blown, 2022 pricing again, but it is important, I think, to know that it's going that way. I'm curious to know, Omair, because of course, a lot of us will look at things like how many sales last month, how many sales month over month, how many of those sales went, over list price. We look at those as sort of lagging indicators of what's happening in the market. But as real estate professionals, one of the things that we'll do is we'll check in with our lending partners and ask, well, what's happening in your world? So, our lending partners have wonderful insight into where the market is going to be next month, because usually people will start their search for a home with a pre-approval. And so tell me a little bit about what you're experiencing, Omair, and have experienced over the last couple of months with regards to mortgage applications, people renewing mortgage pre-approvals that perhaps they let expire over the last couple of years. And there will be people on this call that have not jumped into the market and let a pre-qualification expire, who are wondering if now is the time to get that back, to renew that pre-approval.
Yeah, no, that's a fair question. So what we're seeing is a significant uptake in mortgage applications, pre-approvals, and live transactions. And for live transactions, pretty much every single offer that comes on our desk was a multiple offer. And that also presents its own challenges, because when you're going into multiple offers, a lot of times everyone wants to go in firm. But yes, we are seeing volumes go up at least 40 to 45% month over month. So it's been pretty crazy just over the last few months. And again, I attribute it pretty much all to the interest rate decline in the fixed market. It was challenging because qualification was becoming very difficult last year, right? When interest rates peaked at the peak, you were qualifying individuals at 7 or 8% because of the mortgage stress test. So regardless of what interest rate you get, the bank has to stress test you on an interest rate 2% higher than what you're getting from the bank. So for example, if you're getting an interest rate of 5%, you'd be stress tested as if the mortgage was given to you at 7%, right? This is just to secure the mortgage market, the financial market, and look out for you as well in the future, right? That mortgage payments will be affordable in the event interest rates were to go up. We have a very secure financial system, and partially because of our underwriting policies. But yes, over the last few months, we've definitely seen a significant uptake in applications and just overall inquiries, overall pre-approvals, rate holds. It's you can clearly see where the market is headed.
On that note, Omair, before we move on, and again, I just want to give people a clear picture of where the market is at. And certainly, I just want to remind people that within that, large geographic area that we serve, there are going to be places that are busier than others. There are some that are surging back faster. I want to call on Caitlin Hartley, who is one of our co-panelists today. She's one of the senior agents on my team. Caitlin recently hosted, she had a listing on Botany Hill, which she will kind of talk about at the end of this, but that property sold last night, multiple offers. Caitlin, is someone who hosted the open houses over the weekend. What sort of experience did you observe as a listing agent in terms of volume of people and who was showing up at the open houses?
Well, the volume more than average, I would say, an extremely busy open house. So 60 groups of people in total. And of those 60 groups, about more than half were unrepresented and first-time buyers. So, I mean, it's speaking volumes to the fact that we have people that have kind of gotten off the shelf and back in the market, starting to look at, properties again, turning their mind to real estate and making the move.
Thanks, Caitlin. I just wanted to give people a picture of what they might expect if they're going into open house situations. But let's keep going, Omair, because I think that, I don't know, was that doom and gloom? It feels like it was a little bit dramatic, but again, I don't want anybody to leave this seminar without a clear understanding of where we find ourselves right now in the, last few days of March, the end of, Q1 2024. We are expecting that this surge is going to hit the market probably earlier than expected because inflation has come down faster than most people thought it would. And we certainly here, we're bracing for a incredibly hectic second quarter of this year. But let's move on, Omair, because people want to,
Absolutely,
find out
yeah.
how all this affects them.
Yeah, I'll move on. So one of the things I want to mention is that pretty much all the banks expect interest rates to go down by 2 to 2.5% over the next 24 months. By the end of the year, the expectation is anywhere between 1% to 1.5%. No one has a crystal ball though, right? Like things can change depending on how the inflation data comes in. And how things go. And a lot of it also depends on what happens in the US, because if they don't cut interest rates, it's hard for us to cut interest rates. Otherwise, we could devalue some of the dollar value, and you don't want that as well. So there's a lot of things that Bank of Canada is cognizant of and they're looking at before they start cutting rates, but pretty much every single indication is pointing towards a June, July, rate cut. And that is what a lot of people are expecting. And that's why they're trying to get into the market before these rate cuts happen, because they know once the rate cuts start, prices will likely go up as well. So, this is kind of what I wanted to talk about with supply, demand, and interest rates. And then the next thing I wanted to touch was just renting versus buying, overall, if why should you consider buying if you're renting? So I did a comparison, if you're paying in the tune of $3,500 for rent, some people are paying a little bit less, some people are paying a little bit more, depending on what you're paying for rent. I made a ballpark $3,500, and I looked at that to see what that could translate to if you were buying. So the number is going to be different depending on how much down payment you have access to. But basically, if you are putting down 10%, you'd be able to get you'd be able to purchase a property up to 715,000, and your mortgage payments will still be in that $3,500 range, if not lower. And if you were, if you have the capacity to go ahead with a 20% down payment, you should be able to purchase a property way over 800,000. So I mean, this is massive, right? Because when I talk to people who are renting, rents are going crazy these days. They continue to increase, and $3,000, like, it doesn't get like a cookie cutter place these days is over $3,000. It's unbelievable. So the fact that you can purchase a property in that similar budget, it means that you should think about that at least, right? You should, maybe discuss it with a realtor.
Yeah, Omair, I just want to chime in because this $3,500 number may seem astronomical to some people. Be like, that's crazy, I'm not paying that. That's the average price of a 2-bedroom apartment in Toronto now, which has just gone up exponentially in the last 2 years, because so many of our homeowners, our first-time buyers that left the rental market and got into homeownership, have now in the last 2 years stayed in the rental market. And because there are no new units coming to the market, or very few, it is creating these crazy increases. A couple of things that I just want to point out to people, because you've mentioned a lot about security, and I will say that this is an unfortunate reality, that often the search for a home comes when one of two things happen for buyers. So one of them will be the housing unit that you're living in, that you're paying. It's a 2-bedroom and you're paying, I don't know, some crazy rent, $1,500 for it because you've been there for 8 years. That unit, for whatever reason, no longer will be able to support you as a tenant. So what that means is that the owner has sold the property, the owner is moving back in, one of the owner's family members is moving back in, or the housing class no longer suits your need. You just can't stay in a 2-bedroom because your family has perhaps expanded or your needs have changed. And so we find tenants that are now turned out into that $3,500 price point and left with only 60 days to try and secure other rental housing. So it really creates a lot of fear and panic among around the tenant population. But it does create a false sense of security when you're paying a low rent over a long period of time, because sure, you're saving $1,000 or $2,000 a month, but you're also not building equity. And that's the big issue, because sooner or later your rental situation will come to an end. What kind of control you have over your exit strategy is dependent on whether or not you want to get out in front of it. The other unfortunate situation that I think a lot of renters don't realize, and I say this because somebody on this call here tonight needs to hear it: if your housing unit was built after November 2018, it is a non-rent controlled unit. And what that means is that the landlord, unfortunately, has the ability to, oh, sorry, I think he's stopped sharing, Omair, just so you know, if you want to bring your presentation back up. But this is important because the landlord has the ability to raise the rent in accordance with market rent. And that could be as much as $1,500 a month. So if you are living in a housing unit that is not rent controlled, or if you don't realize that it's not rent controlled, I want you just to pay special attention here, guys. I hope that your rent stays low enough, long enough for you to make a good plan for an exit strategy. But when the 1-year renewal comes up, many landlords are just choosing to exercise their right to increase the rent to whatever market value is. And so a lot of people are blindsided by that. If you have more questions about whether or not your unit is rent controlled, please reach out to the agent that invited you here today. We can help answer those questions for you. But it's an unfortunate reality that often people are blindsided, and then they'll come forward and say, you know what, if I have to pay $3,500 a month in rent, then I might as well buy. But that's a real number in Toronto now, which is just unbelievable. Sorry, Omair, I'll let you get on. I just wanted to, sort of highlight that for people who are renting and experiencing the market right now.
No problem. I was trying to open something and it kind of messed up the presentation for me.
I love it. That's great.
Okay. Yeah. So going back to this, $3,500 will get you, potentially a property of up to $830,000 if you put 20% down. But that's how much you can buy based on, the $3,500 budget, right? But let's take a look at this a little bit more in detail. What does this mean? Okay, so what I did here was I did a very basic comparison. If you buy a property for 800,000 versus just rent it. So let's say if you're renting and you're paying about $3,500 in rent, you may have some property expense with utilities or whatever. Maybe you're paying about $3,650. Now, if you buy, you'd have a mortgage payment. So for an $800,000 property with 20% down, your mortgage payment will likely be somewhere around $3,400. You will have some property expense. You'll have property taxes. You'll have heat, stuff like that. So I kind of narrowed it down to about $517 a month. It could be a little bit less. It could be a little bit more. It's an average that I've taken. So a total of about $3,928. So yes, you're paying a little bit more if you're buying, but what does that mean? Remember, when you're making a mortgage payment, a portion of your mortgage payment is going towards interest, and then the other portion is going towards principal. So when a portion of the payment goes towards principal, it means that you're paying off the actual loan amount. So basically your mortgage payment is going into a forced piggy bank, a portion of it anyway, right? It's going into a forced piggy bank. But apart from that, when you're buying, at $3,500, your annual rent, you're basically spending $42,000 for shelter. That's what you're doing. $42,000 a year for shelter. But you're not getting anything back. Other than the fact that, yes, you get to have a roof over your head, you're not getting anything back on your investment. In 2 years, your $42,000 that you've spent, or the $3,500 a month that you're spending, it will have no future value. Nothing in 2 years, nothing in 25 years. But on the buying side, because the way real estate works, right, we anticipate appreciation. And when I did my calculations, I ran appreciation at 5% year over year. So I assume that the property that you bought will go up in value by 5% year over year. Obviously, that could change. It could be way more, like it's been in the past decade, or it could be less as well, right? But generally, if you look at the GTA market, property does appreciate over time. So based on my calculation, what I did was I took that $160,000 down payment, and I did the calculation. If the house went up by 5% year over year, in 2 years, you would have made $261,000. And in 25 years, you would have made $2,528,000 on your investment, right? And how, right? So a lot of time when we talk about this, I get a question from clients or people, and they're generally saying, "But wait a minute, what about the $160,000? We could have, if you're renting, we could have taken this money and we could have invested this into stocks, bonds, mutual funds, whatever have you." And it's a fair statement, right? Investments are competing with each other. If you're investing in real estate, you could be investing in something else. You could be investing in stocks, bonds. You could be investing in crypto, right? So let's look at that as well. I did a little, comparison, and I used very small numbers. So let's say you have $25,000 today. Now you can obviously buy real estate with it, or you can invest it into, let's say, a stock. And let's say that you invest it into a stock that is giving you 10% growth every year, which I think is very reasonable, and it's great. If I'm getting 10%, from a stock guaranteed, I would love it.
Oh my God, Omair, what stock is that? Please tell me.
Yeah.
I'm in a portfolio that does not respond. Like nothing has outshone my real estate portfolio in the last 20 years. So if you have a 10% guarantee, please let me know, because I'm not seeing a 10% guarantee on it.
No, I know. Especially in the last few years, stocks took a beating, but everything took a beating. It was economic downturn, right? But let's say you got a hold of an amazing investment advisor, and they were able to set you up with a 10% increase. So how would that work? Well, this is how it would work. You take your $25,000 and you would invest it, and in the first year, you would make $2,500, right? 10% on 25,000 is $2,500. So your money would then become $27,500. This is the power of compound interest. Then in the second year, sorry. Then in the second year, you would make 10% on top of that. You know, you'd have 30,250 in 3 years, you turn that money to 33,000. Four, same thing. Fifth year, same thing. So what's important to understand is the compound interest will help you significantly. You will end up making a lot of money from your 25,000. You know, you had 25 grand in 5 years, you are now at $40,262. Was that clear there, or any questions? You good? Okay, all right. Now, if you compare this to real estate, same scenario, you take $25,000, you invest it into real estate, $25,000 will buy you a home for $500,000. That's the minimum down payment required to buy a property for $500,000. If that $500,000 home appreciates 10% in 1 year alone, you've made $50,000. That is the power of leverage, right? Here we were looking at the power of just compound interest alone. Here we can see the power of leverage, and this is what you get in real estate, right? Because you're able to purchase this asset with that down payment, you will realize the gains on that particular asset. So same thing, in 5 years, you could potentially make $250,000 as opposed to $40,000. So this is my answer when anyone says, we can continue to rent and we can invest. Absolutely, you can. Or you can invest in real estate and realize the gains on the real estate investment. The next thing is I just kind of wanted to show you historic statistical data from TREB, the Toronto Real Estate Board, right from their website. You can Google this as well. This shows you property average prices over the last 50 years, all the way from 1977 till now. And one thing you'll notice is that pretty much every 10 years, average prices in Toronto have doubled. It's insanity. And this is data, not over 2 years, 3 years, 5 years, because that's what you hear about, right? Whenever you're in a real estate conversation, someone will say, over the last year, things went crazy. Over the last few years, things went nuts. Not really. This is over 50 years of data, and prices have doubled every 10 years. Now, obviously, if you look at the data very carefully, you will see that there were peaks and valleys, right? Like, look over here, right? Prices went down, prices went up, prices went down. So there are peaks and valleys, but one thing is true. If you're holding on to real estate for the long term, you're coming out well ahead, not just ahead, well ahead.
Sorry, I just wanted to chime in and say, I'm an exceptionally conservative investor by nature. I don't buy anything, and I don't, counsel any of my clients to buy anything unless there's a clear path to profitability. When we give our clients profitability projections, whether it's for an investment property or more especially if it's for a first-time buyer and they really need to see what the math is, we use that 50-year GTA average, it's actually just over 5%, but we use 5%. But it's important for people to know that's not 5%, 5%, 5%, 5%. It might look like 5%, 7%, 3%, 10%, -2%, 0. It starts here and it ends here, but the path that it follows is a little bit staggered. And I think that's important because we've had a little bit of volatility over the last few years, which has caused people to understandably pause, because a confused mind will always say no. That's a function of how we react to uncertainty as humans. But it is a really important thing to remember that I don't think there's anybody on this call or in the public that would suggest that real estate 5 years from now or 10 years from now will be worth less than it is now in the GTA. I have a client, when I started in real estate very, very early on, sold his house at Coxwell and Danforth, waiting for the market to crash. He was going to sell. He was going to wait a year, wait for the bubble to burst. He sold a detached house for $232,000. And I saw that house recently transact a couple of months ago, resold for $1.7 million. He's still in rental. All of these years later, waiting for the bubble to burst. So it's really important to remember, guys, we can't time the market. You can't time the market. Nobody can time the market. Housing is not discretionary. We need to pay for a roof over our heads. We might as well be paying ourselves. And I think you beautifully illustrated that already, Omair, with those slides. But I love this graph because this will sort of show you that it's not always, real estate always goes up. Like any asset, there can be fluctuations and variations, and we've certainly seen that in the last 5 years.
Absolutely, right? So again, we have to be very careful when we talk about speculation, right? But if you are again buying to live and you're holding real estate in the long term, I think you're always going to notice that you're going to come out ahead. And yeah, this kind of graph shows you the sales data, so you can see the peaks and valleys. Just like any other asset class, you will see peaks and valleys. But overall, this is not a volatile asset class, as you can see, right? Okay, so I kind of now want to just talk about the home buying process and really what it means to get into a mortgage or take out a mortgage and what the process is. So the home buying process obviously can differ for everyone. Carol, do you want to talk to this a little bit?
I think about, if you want to talk about we'll talk about the importance of a pre-approval, I think. And to Omair's point, yes, it changes. If you just want to go one slide back, Omair, I'll just touch on it super quick. What your home buying process looks like is going to differ a little bit for everybody on this call. And everybody watching at home later, because the process of buying a condo will be a little bit different than buying a detached or a freehold home. And then within, the geographic area that we talked about, there's going to be patchwork of market conditions that are going to mean the process is a little bit different. In some places, it is still a situation where you can go in and negotiate conditions, push the seller on price because that market hasn't, quite recovered yet. In other places, we are back into seller's market territory. So your path to home ownership is going to look a little bit different depending on what you're looking for, what your price point is, and where you're looking to move. But this is part of the conversation that I think has to happen with people after the fact with the agent that invited them on this call. Because I always remind people, I mean, we've made a very compelling case, I think, for why, if all things being equal, if you have the ability to buy now, that maybe you should think about doing it. But on the flip side, we have to remember that not everybody is going to be in a position to buy now. The time for you to buy isn't when the market is down or when the conditions are great for you. It's going to be when you are in a financial position to be able to do it comfortably and without overextending what you feel comfortable doing financially. So I think that's really important. And, we have an approach to selling real estate, which is very no pressure. We are here to inform and educate you so that you can make the decision that is right for yourself or your family when the time is right for you. And everybody's path to home ownership will be a little bit different. Obviously, getting a pre-approval, understanding what it is that you can buy is important. Working alongside a very skilled real estate agent that can help you navigate these rapidly changing market conditions, that's important. I always remind people, we are in the most oversaturated market for real estate agents anywhere in the world. 1 in 76 people have a real estate license. The guy that cuts my lawn has a real estate license. I joke about that, but the reality is when the market has been good for 2 decades, lots of people jump in because it doesn't take a lot of skill to be able to sell a house. You put a for sale sign on a lawn, and then multiple offers come, and everybody looks like they're a hero. The challenge becomes when you get a more complicated deal, or you get first time buyer who's really stretching on affordability, when you need to come up with a creative solution to get them into the neighborhood that they want to be in. That's where the skill of a really highly trained full-time real estate agent comes in. And there is no other reason that 95% of the real estate in the GTA is traded by 5% of the agents. That's a true statistic. And it's a reflection of the fact that, a few of us do it really, really well. And a lot of us don't take it seriously as a profession at all. I don't say that to, throw anybody under the bus, but who you work with in a market like this really matters. And so your next step really should be sitting down with somebody. Hopefully it's somebody, that's invited you onto this call, but sitting down with an agent that really takes the time to explain to you what this process looks like, the ins and outs, and where there is no pressure to move forward until you feel like you are educated and empowered enough to make the decision that's right for you, based on the market conditions that exist for the type of of home you're thinking about buying. It's a larger discussion. We'd love to have it with you. But I don't want to go too far down this rabbit hole today because we could talk about agreements of purchase and sales and the importance of having a home inspection, guys, all of these things. We'll get there, but I'd love to do it on a one-on-one basis with the people that are on this call. But let's talk about the importance of a pre-approval, because I think that's where a lot of people will consider and should consider starting their search, Omair, and you can speak to that.
Carol, that was inspiring. I kind of want to buy a house now. Like right now.
But do you have a pre-approval? That's the question.
That's the question. Okay. So the importance of pre-approval. Now, when you start your process and you know you'd be getting a mortgage or you'd be needing financing to purchase a house, unless you're cash heavy and you're thinking about purchasing a property in cash, which is great. If you do need financing, this is the first step, and you need to do this right away. And the reason is very simple. It's like, if you don't do a pre-approval, you don't get a pre-approval. It's like going to, like Sports Check and thinking about buying a pair of sneakers, and you don't know what size it is, so you're trying on every single shoe in the store. It doesn't make sense. It won't. You don't know what works for you. So the first and foremost, first step, get a pre-approval. In this step, your mortgage broker, someone like myself or me, we would look at your personal income, your assets, your liabilities, your credit, and we will look at your long-term and short-term goals, and we'd be able to figure out exactly how much you can qualify for, and not only how much you can qualify for, how much you want to pay. Because let's say the bank says you can take out a $2 million mortgage. Is that something that you want to do? Maybe you don't want to take on payments for a $2 million mortgage. So these are kind of things that we talk about. The second thing is we get to hold your rate for you. Some institutions now even hold the rate up to 130 days, which is fantastic in a somewhat volatile interest rate market. So what that means is that if you were to get a pre-approval today, we'll give you an interest rate and we'll hold it for you. So no matter what happens in the market, let's say if Bank of Canada increases rates or bond markets go haywire and rates go up, in the market, whatever rate was given to you on your pre-approval will still be held for you up to 120 days or 130 days, whatever it is. So you have that sense of security that you can go start shopping around, and that interest rate will at least be held for you. And the last thing, obviously, your realtor will love you because you'll know exactly how much you can afford. Your interest rate will be held, but more importantly than that, you'll be able to go into multiple offer situations well prepared, right? You'll be able to go into offer presentations with a lot of confidence, and that's very important these days. When you go out, you'll notice that for every single house that's on the market, there's 10 or 15 other families looking to buy it. So there's multiple offers, and you have a pre-approval. You know exactly how much you can qualify for. You can come out ahead and beat out the other buyers.
I think I'd love to just talk for a minute, Omair, about the other big thing that comes up a lot during the pre-approval process. It gives you a clear understanding of what you can afford, yes, but it also gives you the opportunity to run defense on inaccuracies in your credit report, which is a big one, I think. A lot of people on this call will have student debt, and a lot of people are quite surprised that when they pull their credit report, usually in conjunction with a mortgage application, they find out that Canada Student Loans, who is notoriously bad at making mistakes on your credit application. So you go to apply for a mortgage, you find a house that you really love, you've got 5 days to get your financing arranged, you put in your financing condition, you put in your mortgage application, they come back and being like, there is something seriously delinquent on your credit report, we can't get you approved. And you find out that you had missed a $13 loan payment 6 years ago, and Canada Student Loans was still sending the notices to the address that you lived at when you went to, Queens. They are notoriously bad for it, guys. That's just one example. But it is a wonderful opportunity to just say like, hey, let me have a look at my credit score, because interest rates and preferential pricing will be offered to people that have good credit. And if there is a problem, it gives you the opportunity to fix it without delaying your home search later on. And it can take a long time to fix inaccuracy in your credit score. If you've got a generic name like John Smith, God help you, I love to say it, but there's a good chance that John Smith's, who lives 4 blocks away from you, who didn't pay his Canadian Tire credit card bill, could have been inaccurately reported on your credit. I don't say that to alarm you. There are remedies and you have the ability to fix that, but it does take time, and you don't want to add that when the market is escalating or when you're ready to get into your house. So the time to do your pre-approval is well in advance of when you're actually ready to put pen to paper. As a realtor, I'd rather I have a client that has it and doesn't use it than needs it and doesn't have it. If the house that you've always wanted to buy hits the market and you want to buy it and you don't have a pre-approval, it may be very, very challenging to get that offer accepted. So something to think about, guys. It's just about thinking 2 steps ahead by getting your pre-approval done ahead of time.
Yeah, absolutely. That was a very good point, Carol. And I'll add to that, and I'll just talk a little bit about the fact that banks underwriting may not work exactly how you think it works. So, for example, right, you may based on your, let's say, pay stubs, or based on your T4s, let's say you're making $150,000. That because your income is, let's say, salary plus commission, or maybe you get, bonuses at work, right? And you think that, yeah, I make $150,000, I will qualify for this house very easily, no issues, no worries, right? And then you actually put an application in at the bank, and the bank comes back and says, yeah, we need to see 2 years history for your commission income or for your bonus income. And you're like, wait a minute, I just started the job 8 months ago or a year ago. And the bank says, okay, then sure, we'll use just your base salary, which is 100,000, and then knock off the 50 grand that you make and you can make, and now you don't qualify for that house, right? So it's things like that as well. Sometimes you may think that everything is very straightforward and cookie cutter, but when the bank's adjudicator or underwriter is reviewing a file, they're looking at a lot of things that you may not know. So absolutely, it's always in your best interest to get that pre-approval done. It's due diligence that's being done for you by the bank or a mortgage broker, and it's costing you absolutely nothing. So definitely, always do a pre-approval. Next thing, I just wanted to point out how down payment in Canada works. So there's 3 tiers. Essentially, the minimum down payment required for you to be able to purchase a home in Canada is 5%, as long as the property is valued at $500,000 or less. So for any property that is $500,000 or less, you can put 5% down, which is $25,000 for a $500,000 property. Homes between $500,000 and $999,999, it's a little bit more interesting. So essentially what happens is that the down payment gets tiered for houses above $500,000. The way it works is that you have to put 5% for the first $500,000 and 10% for the remaining amount over the $500,000. So I'll give you an example of that. So let's say you're looking to purchase a property for $600,000. The minimum down payment would be 5% of the first $500,000, which is $25,000, and 10% of the remaining $100,000, which is $10,000. So your total down payment would be $35,000. So it's tiered. However, if you're looking at a property that is over $1 million, you're going to need 20% down or more. There's no ifs, ands, or buts about that. You can't buy a property for $1 million or more with less than 20% down. It is something that hopefully will change in the future, especially looking at the average home prices these days. But as of right now, you cannot purchase a house for over $1 million with less than 20% down. The other thing is that if you purchase a property with less than 20% down payment, you do have to get what's called a CMHC mortgage insurance or mortgage default insurance. It's offered by CMHC, which is Canada Mortgage and Housing Corporation, which is a crown company. And then there's two other companies that offer it as well. One is Sagen, and the other one is Canada Guarantee. This insurance premium is added onto your mortgage. It's a lump sum premium that gets added onto your mortgage. It does absolutely nothing for you. It is actually a default premium that protects the bank. So essentially, if you were to purchase a property with less than 20% down, you'll get this fee charged, added onto your mortgage. And the whole point of that fee is that, in the event that you decide to no longer pay your mortgage, the insurance company will pay out the bank. That's all it is. But you have to pay it, unfortunately. The premiums depend on how much your down payment is. So if you're putting down 5%, your premium would be 4% on the mortgage amount. If you're putting down 10%, your premium will decrease. It'll go to 3.1%. If you put on 15%, it'll go down to 2.8%. And again, if you're putting 20% down, there is no mortgage insurance premium added onto your mortgage because none is required. All the risk is being taken by the bank. So I'll give you a little example of how that works. So let's say you're purchasing a property for $500,000. You're purchasing property for $500,000. Your down payment is 5%. You're looking at a $19,000 CMHC premium. It gets added onto your mortgage balance. So you don't have to pay this upfront. You don't have to pay this in a lump sum. It does get added onto your mortgage balance. And as you can see here, as your down payment increases, your CMHC loan premium decreases because the risk is lower to the insurance company. At 20% down, there is no premium.
Can I just make a point, Omair? Because I think there's going to be people that are like at home with like a piece of paper and like a calculator trying to figure that out. I just want to be clear, guys. You don't need to be a mortgage expert at this. Really, what you need to do is to sit down with somebody that can explain your circumstance to you in clear, plain English. So as opposed to trying to figure out exactly where you fall on this table or what it's going to cost, you're going to sit down and be like, here's everything you need. Walk me through what my mortgage application is going to look like. Walk me through what you need, and then show me what my payments are going to be every month. I think that most people shop the payment, not the back end numbers. And so I think if you, like me, struggle with understanding, complex math and ratios and those sorts of things, this is the majority of the population. It's important that you know that somebody's going to sit down and explain it to you. You don't need to know interest rates and bond yields and all of this terminology that we've talked about today. All you need to know is that you're sitting down and you're talking to somebody that can explain to you in simple, plain language. And that goes for the mortgage process as well as the home buying process as well too.
Yeah.
There's one other thing I just want to touch on as well too, because I do love this comment all the way. So we had the responses to the homeownership myth questions, and there was a couple of people that said that they should wait to buy their dream home. And this is a common sentiment that I hear. And perhaps it's not a dream home, but perhaps they're looking at these numbers and say like, okay, well, you know what? I'm saving $2,000 a month right now that I'm putting towards my, my in my piggy bank for my deposit on the down payment of a home. I'm going to wait until this time next year because I'll be $24,000 ahead. You and I, Omair, know what the downside of that is. Of course, the reality is that in almost all cases, you can't outsave the market. And I just want to speak to that because there will be people here today being like, okay, great. If I can save 10%, then I'm going to save, $6,000 on the CMHC premium. The reality is if the market continues to appreciate, even at the baseline of where it's been for the last 50 years, let's use 5% as a round number, on a $500,000 purchase, that means you need to save an additional $25,000 just to keep up with the pace of growth in the market. You'll have to have $25,000 more in your pocket or be willing to put $25,000 more on your mortgage just to keep level with the market, as opposed to somebody who buys earlier, if they're in a financial position to be able to do so. Somebody who buys earlier, who then at the end of the year has benefited from that growth instead of having to come up with that extra. There are certain caveats, as an example, sometimes people will say, you know what, I'm the beneficiary of my grandmother's estate, and later this year I'm expecting to receive $150,000, so I'm going to wait. I suppose if you have a rich aunt, I don't, that would be a reason to wait. Sometimes people will tie it into wedding money as well. So if you're like me, you've gone to a giant 400 person Italian wedding. I'm married to an Italian. I love it because everyone brings cash to the wedding, and there's a good chance you're going to come out ahead at the end of that. That may be a reason to wait if your financial circumstances are going to change dramatically. But the reality is, for most of us, is it's near impossible to be able to outsave the market if we're trying to just skim off of our paychecks every single month. $25,000 is just simply impossible, even for the best savers among us. So I think it's just important to keep that in the back of your mind, guys. If you're trying to outsave the market, it's really, really, really difficult to do so. I don't know, marry an Italian. Does this happen at Indian weddings too, Omair? Like, do you also give money at Indian weddings? Is this a big thing?
Yeah, no, it's all cash, now at least, thankfully.
I love it because I married like an Italian Irish, but the Irish is obviously more prominent in my husband Regan's family. And so we ended up with like steak knives, and like somebody brought us a toaster. And I'm like, is this a toaster box full of money? It wasn't, guys. It was just a toaster. So, but unless you're coming into a large amount of money, just be mindful of the fact it's really, really hard to save that extra. So I just wanted to pause on that because it's a common misconception that I'm sure you and I both hear, Omer.
Absolutely. So there was a question in the Q&A, and they were asking if the CMHC premium drops off when you hit 20%. So I'm not sure if you're saying if you at the time of purchase, or as you own the property and you accumulate more equity.
Oh,
But
no, I think it's a question, if I can understand it. Maybe Simon can clarify, but I'm interpreting this question as if you are, to be clear, Simon, if you're putting more than 20 or more % down, you do not require, there is no requirement that you pay a CMHC premium. CMHC premiums are meant to insure the lender against a high ratio borrower in case of default. If you are putting more than 20% down, there is no premium because you're not considered to be a liability great enough that you need to purchase an insurance policy. You're very unlikely to default on your mortgage. And I thought this was a great question because and maybe Omair, I don't think that this is a slide in your deck today, but you shared with me a few weeks ago a really staggering statistic, because one of the other misconceptions, and it wasn't on our question list today, but I think you should address it, where people seem to be just waiting for this like tsunami of mortgage defaults to hit the market, and then they're going to wait for one of those distress sales and buy them. As a real estate professional I can tell you that there are almost no defaults happening on mortgages. Remember, for a couple of reasons. First of all, as you've already learned here today, it's actually pretty challenging. There's a lot of hurdles to jump to be able to qualify for financing in the first place in Canada. But the second point is that, housing is not a discretionary expense. People will stop eating out. They will stop taking luxury vacations. They will turn in the keys to their Tesla long before they decide to default on their houses. And even when they do, the bank is going to be very supportive in trying to find a way to keep them in their houses and in their payments, because the bank doesn't want your house back. They want you to continue to try and make payments on it. And so, Omair, maybe you could share that statistic. I don't know if you have a slide handy, but it was astounding to me at the low number of mortgage defaults currently in our market right now.
Yeah, I may have that somewhere. Let me see. I don't want to.
I put you on the spot. And I will just say, while you find it, Omair, I just want to address anonymous attendee. I love all the questions. Whoever this is, man, woman, or otherwise, I am so impressed by the level of research. This is somebody that I want to sit with and just unpack how your mind works, because these are some great questions here, and I think you'll touch on some of them as well, Omair, as we go through the final bits of our presentation. Guys, as a reminder, if you haven't had a chance to vote in the poll yet, now would be a great time to do it. You can click on polls and quizzes in the bottom, and then we're going to just address it at the end. It looks like a lot of you have voted, and some of these things we've addressed already. Do you have a slide, Omair? Or if not, maybe you can just share with us as you move on.
I do have it, and you know what?
The amount I can tell you, because I remember it quite clearly. It was in the entire country of Canada.
Oh, don't say it. Don't say it. Don't say it.
Oh no! Okay, we're going to ruin it for it.
I know you are doing a giveaway as well, right? So what I'll do is
Oh, do you want to guess at it? Does anybody want to guess? You know what? This is a great way to have some audience interaction. Why don't we do this? The winner of the IKEA $100 gift card will be the person who can guess in the chat close to the closest thousand how many mortgages are currently in default in Canada by the end, because I think you're going to be shocked at this. Past due, sorry, not default, but currently.
Yes. So the way the way that CMHC, Canada Mortgage and Housing Corporation, the way the way they track defaults is by looking at how many mortgages are past due for more than 90 days in Canada. So really, yeah, that's the question. And I know you're doing your own giveaway as well, Carol, but you know, on my social media, we talked about doing a giveaway as well. So really, let's see if someone gets this right. We'll do a $100 giveaway to Amazon on on this call. So what do you guys think? You can put it up in the chat box. What do you think is the percentage of mortgages that are past due in Canada right now?
This was shocking, guys. I was shocked to find it. So far, we've got one guess in the chat from Soniel. Oh, we've got a couple of guesses at 1%. Anybody else? 35%. My goodness, Carlos. But we'd all be jumping off bridges. 90%. Somebody thinks 90%. 90%. 9 out of 10 of us are defaulting on our mortgages right now. 3.5%, 0.8%. These are great guesses. Yeah. Thank you, Caitlin. 0.01% from Emma. Zena, around 0.15%. Jason is suggesting that it's 7. Katan, 10%. Oh no, Carlos is adjusting to 2.6. Carlos is feeling much more confident about the economy. I love it, Carlos. Sarah, 1.3. I'll give everyone a minute to find the chat. So this was eye-opening for all of us because I can't tell you how many times I have heard from people like, find me a house and find one that is in economic distress because I'm gonna jump all over that and buy that economically distressed house. 1%, a lot around 1%. Oh, Zena's changing her answer. 0.17%.
So I just want to pause right now, and I just want to say, Carlos, based on what you're saying, you think that there's like 17 people on this call that are past due on their mortgages?
No, Carlos has changed his opinion to 2.6.
Oh, all right, fair enough.
Sure, Carlos is good. 0.17. Do you want to give us a number?
Wow. Okay, all right. So
as a percentage of 100, how many people? Soniel has changed to 0.14.
0.17. So Mike, wow, you were right on the dot.
0.17. 17. I feel like Mike probably researched this or Mike
looked it up.
Architects.
Yeah. So that's amazing. So this is like there's 7 million mortgages that are outstanding in Canada, and out of 7 million mortgages, only 0.17 were past due for over 90 days last year. And I just want you guys to understand that 4 million people live alone or by themselves. So 0.25% of this number is just people that are actually deceased, right? So it's because a lot of people live alone, right? If they've passed away, they're not making the mortgage payments, nobody else is. So
it's 0.17, and of that, a quarter of those people, 25% of that 0.17, the payments are not being made because
they're no longer here.
Okay, and so the state is in some process of probate. Some very close guesses, yes. But I think that this speaks to the misconception, Omair, that there is going to be this catastrophic collapse in the real estate market and that we're all going to go into default. It's a really interesting statistic because I have actually the mortgage numbers specifically. I want to be clear, guys, we talk about interest rates. 39% of Canadians own their home with no mortgage at all. So when you walk down the street, you pass 100 homes, 39% of those homes have no mortgage at all. 32% of those have more than 50% equity. They're not defaulting on a mortgage when they have 32% equity. And 29% of homes have less than 50% equity, but more than, but obviously are not in default. So those are some pretty staggering numbers. So for the better part of over 70%, they don't there is not much interest in terms of what's happening with the mortgage market because their payments are very, very low or non-existent entirely. So something to keep in mind, guys, because there's a lot of discussion about like when the mortgage market collapse. Let's move on, Omair, because I know that we want to get to some questions and answers tonight. But yeah, some great guesses, guys.
Absolutely. Okay, so the next one is really fixed versus variable. I get this question 10 times a day, every single day. The answer always is, it depends. It really does. It depends on your short-term and long-term goals. We sit down and we discuss it. We figure out exactly what's important to you. You know, going fixed or variable, there's no wrong or right answer. You do it for different reasons. Variable rate, you know, anyone who was on variable rate over the last 10 years, they saved a lot of money. And then, you know, the last 2 years happened when Bank of Canada increased rates 10 times. So, you know, like people, a lot of people went from variable to fixed. Over 60% of our clients right now are taking a fixed rate mortgage, mostly because they're lower right now. And the fact is that Bank of Canada anticipates cutting rates in the next 24 months. So our advice to anyone who's looking right now is, again, it's based on, you know, your individual circumstances. But having said that, we're saying delay locking in to a long-term mortgage. For example, if you were to take a 5-year fixed mortgage today at 5%, and in 2 years, in the same mortgage rate is being offered at 3%, you're going to kick yourself. And if you try to break that term, you're going to pay huge interest rate differential penalties or huge penalties to break that fixed rate mortgage, right? So you can avoid that by taking either a shorter term, like a 2-year or a 3-year, or you could roll the dice and take a variable rate mortgage and, you know, just wait for the rates to come down. But if you're going to do that, just be prepared that we're going through some turbulent times in the variable market. So again, this is something that we have to discuss with you, and you know, it's not something that it's not a one solution that fits everyone kind of deal. The next thing, again, this I know we're probably running out of time at this point, but if you are a first-time home buyer, there are a lot of programs out there that are offered by the federal government that will support you to make your purchase. A couple of them that are very, very important are the number one is the land transfer tax rebate. The land transfer tax rebate is fantastic. Depending on where you're buying in Ontario, if you're buying anywhere in Ontario, you will get a tax refund of up to $4,000 for a first-time home buyer if it's anywhere in Ontario. But if you're buying in the city of Toronto, then you will get a further $4,475 on the tax rebate, on the land transfer tax rebate. So essentially, you can get up to $8,475 towards your land transfer tax rebate if you were to buy as a first-time home buyer. Now, you have to be 18 years of age. You have to be a Canadian citizen or PR permanent resident. And again, the property that you're buying has to be a principal residence. And you cannot have owned a home for in the last 4 years, you could not have owned a property or a home anywhere in the world. So again, depending on, you know, where you buy, you'll have a land transfer tax payable, and you can get a rebate of up to $4,000 outside of Toronto and $8,475 in Toronto.
But you have to be willing to spend $120 on brunch every Saturday if you live in Toronto. And I think that's the important caveat to remember that. But I wanted to say, Omair, because there's a lot of information to unpack with all of these different incentive programs. It's really important that you sit with a mortgage broker that can walk you through and say, you're eligible for this, you're not eligible for this, but you're eligible for this, and walk you through step by step. There was a lot of questions around RRSPs and the way that they can be used. Can you just give us high level on that? Because many first-time buyers will leverage the tax shelter that they've received from their existing RSPs in order to purchase their first home. High level, Omair, can you just speak to anybody who's got money in RSP right now who wants to use it?
Absolutely. So if you're a first-time home buyer, you can withdraw up to $35,000 tax-free from your RRSPs. If you do that, though, it does have to be repaid back into your RSPs over a term of 15 years. If you don't pay it back in the 15 years, then there's some tax implications. But yeah, you can borrow the money from your RSPs. You can use it for down payment. A couple of things that you should know is that the RSP obviously should be in your name if you're doing that, if you're doing the withdrawal. You have to be a resident of Canada at the time of the withdrawal. And your RSP contributions must have stayed in your RSP for at least 90 days before the withdrawal. And if you've already bought a home, you can still withdraw the money as long as it hasn't been over 30 days that you bought the house. So we've seen, a lot of times people close their home transaction and then take out the money from their RSPs. You can do that as well. It just can't be after 30 days of you closing on a house. Otherwise, it does not count as a RSP, first-time homebuyer RSP redemption.
There's a question from Gabriella Omair about did the government not just discontinue the first-time homebuyer incentive? This is really an important question because there's a lot of misunderstanding about this. Obviously, there's a whole bunch of first-time buyer incentives that are available. The government discontinued one that was particularly unpopular, which meant that most homebuyers were not taking advantage of it because of the way that it was structured. I don't think you need to go into the details because it's not available to people. But to be clear, there are still lots of first-time home buyer incentives that are available. This one particular government program, very few people were opting into it, and that's why they decided to discontinue. Would that be a fair statement, Omair?
It was an election promise. That's the reality of it, right? It was during election time when the government put something out there that sounded really cool. Unfortunately, it just didn't work. The other main thing is that it was essentially an equity share program where the government was taking a share ownership of someone's house. And those programs are just not popular, right? And why should they be? Would you want someone to take a part ownership in your house? I wouldn't. So yeah, the program did not really work well. It's gone. Not many people are going to miss it. There's a lot of other programs out there. And this one in particular, the First Home Savings Account, this is free money. If you guys are thinking about getting into the market, make sure you pay attention to the First Home Savings Account, or the FHSA. The FHSA, you can put up to $8,000 a year into this account. $40,000 is the max. So you can put $8,000 a year into this account. And when you put this money in, it becomes tax deductible. So let's say you put in $8,000 this year, $8,000 next year, and then you buy a house. You can withdraw the money, and you'd be deducting the contributions from your taxes. So you'll get a nice tax return back when you file your taxes. It's literally free money, but you have to be a first-time homebuyer. The other thing that you should know about this is that you can only use it for the purchase of a residential home that you're looking to occupy. And there are some eligibility criteria for this as well, just like everything else. You have to be over the age of 18. You have to be a resident of Canada. But it's a fantastic program, and anyone who's looking to buy a house should take advantage of it.
Can I ask quickly just about the way that this relates to new Canadians? Because there's going to be many people on this call and that watch this call later that consider themselves new Canadians, and there's this misconception that if you're not born here, you are somehow banned from owning real estate. And to be fair, Omair, it's a common misconception because in other places in the world, that is a true statement, but that is not true in Canada. There are some restrictions around eligibility depending on what your legal status is here in Canada, but maybe you can speak to that just for a very high level. And again, if you're new to Canada and you're in the process of applying for a permanent residency, citizenship, some form of, or you're intending to stay for a long period of time, it bears having discussion not only with your real estate professional, with a mortgage broker, but also a real estate lawyer. We can assist with those things, but maybe just very high level, Omair, you can kind of touch on those things.
Absolutely. So really, you have to understand there's three types of designations, right? So you have a Canadian citizen. You could be born here, or it could could have immigrated to Canada. If you're a Canadian citizen, you can buy in Canada. No issues, nothing, right? The other is a PR. So if you've come over to Canada and you could have been a student, you could have been You could have been on work permit, whatever it is, right? Once you get your PR, your permanent residency, you can buy in Canada without any implications, just like a Canadian citizen can. The third one would be a temporary resident or someone who's on a work permit. This one is interesting because someone who's on a work permit, technically they can buy in Canada, but they could be implicated towards the non-resident speculation tax, the NRSD tax. So this is something that you have to talk to us about, or you'd have to talk to your realtor or your lawyer or your accountant about. But long story short, if you come to Canada and you have a work permit, there are ways that you can there are ways that you can avoid the NRSD tax. One would be if you have a spouse who's a Canadian citizen or a PR card holder. The other one would be if you are members of if you're called a protected person. So basically someone with a refugee status, they don't have to pay NRSD taxes. And the third one is if you are part of the Ontario Nominee Immigration Program, the ONIP. If you're part of the Ontario Nominee Immigration Program, you do not pay the NRSD tax. But otherwise, you may be liable to pay the NRSD tax. But again, you could get that back if you get your PR in a certain amount of time. And the third one, obviously, would be someone who has no status and they're a non-resident. Now, I think everybody would have heard that Canada put a 2-year ban on the non-resident on non-residents, meaning that they cannot buy in Canada, which is also partially true because there's lots of exceptions there as well. So if you're a non-resident, you can still buy as long as the geographic location is not in the Greater Horseshoe. So if you're outside the Greater Horseshoe, you can still buy. You have to pay the NRSD taxes. So there are some implications. The best thing to do is talk to an individual. Talk to a professional. And we'll be able to guide you for your, in your circumstances and what works for you. But yeah, we've done a ton of mortgages for individuals who are, newcomers to Canada. They don't have any credit even built up here, but they can still buy. They can buy with 5% down. They can buy with 10% down. So yeah, absolutely.
So Omair, and we can go through, I think the rest of these slides, we're going to share the deck with people so that they can compare and contrast all of these things. But I really want to just speak, and I apologize if I'm getting ahead of myself and you have a slide, because I want to just leave a few minutes for questions at the end. You've talked a lot about and obviously shared a wealth of information about you as a professional. Explain the role of a mortgage broker and how that's different than somebody that just walks into their bank and says, like, I need a mortgage, or fills out an online calculator. Maybe you can explain why your role is different and how, like a real estate agent, a mortgage broker is here to assist a buyer.
Yeah. The reality is, Carol, I've worked for a bank for over 9 years, right? Multiple banks for over 9 years. So I've been on both sides. And really, you may be able to find a lovely individual at a bank. You may walk into your bank, and it could be Scotia, it could be TD, it could be RBC, and they could help you out with a mortgage. But the reality of the situation is, when you go to a particular bank, they only have access to their own bank. So if you're going to TD, you're only getting TD's products and services, and either you're eligible for them or not. A lot of times, what a lot of people don't understand is that underwriting guidelines are not the same across the board, right? Bank A takes a look at income a little bit differently. Bank B looks at rental income a little differently. Bank C has more discretion on income to debt ratios. So it's stuff like that, right? Just because CIBC is saying no doesn't mean that you can't get approved at Scotiabank, right? I'll give you a prime example for that. We had a client a few days ago who went to their own bank, TD, and unfortunately they got declined because something came up on their credit bureau that just didn't that wasn't good, right? So the credit bureau showed some past due delinquencies, and TD said, yeah, no, sorry, we can't lend you, X amount of dollars that you're looking for. And they thought that, the clients thought that that's it. They're not able to get approved anywhere else. Well, the realtor referred that client to us. We looked at their profile and we said, wait a minute, let's look at your TransUnion report, because Equifax is not the only credit reporting agency. We looked at TransUnion. TransUnion did not have that delinquency. We know Scotiabank takes TransUnion primarily. We took that same client who was going to TD. We took him to Scotiabank, got an approval, even better rate. So, if you only look at one institution, the one that you're banking with, you may be missing out either on rates, on service, or worse, on options. And we're able to provide those different options. And it's almost like going on Expedia when you try to book a trip or something, right? You can see pricing come out for every single airline, right? Just like that with a mortgage broker, we're able to see rates for every lender. We can see BMO, Scotia, TD. We can even look at credit unions. We can look at finance companies like Manulife and Desjardins. So there's a lot of things that we can do because of our overall access to lenders than what your bank can particularly do. And one more thing that a lot of people don't know is brokers kind of like us. We're top 1% in the country for volume funded. What that means is that we do a lot of business, and banks give us pricing based on the amount of business we do. So, for example, if an individual client goes into, let's say, TD, and they ask what the best rate is for them, TD's pricing that transaction based on a $500,000 mortgage or $1 million mortgage. When TD gives us rates, it's like Costco, right? They're giving us rates based on $150 million of business that we send TD. So a lot of times we're able to get better rates than what a client may be able to get directly from TD or CIBC or BMO.
I think it's an important question, Amir, because there's a lot of misinformation around both how real estate agents and mortgage brokers are compensated. So maybe you can explain to people, like, this all sounds great, Amir. I'd love to work with you to get a pre-approval, but how do you get paid in all of this, and do I pay the price for that?
Yeah, and that's a very fair question. So mortgage brokers get compensated exactly how mortgage professionals at the banks get compensated. We get paid by the bank. So we are an acquisition channel for the banks, and we're actually one of their fastest growing acquisition channel. So instead of bank having their own mortgage sales force, we're able to position banks' products to our clients, and we get paid from the bank for that. However, I'll kind of go a little bit into detail with this. Because of the way we operate, we have access to non-bank lenders as well. So these are private lenders, institutional lenders, and Schedule B lenders. Now, if we are taking a transaction to one of these private lenders or private lending institutions, then it is possible that we may be able to, or we may have to position a fee for our service because those lenders will not compensate us. But as far as working through the banks or with the banks pay us directly. It does not cost anything for clients.
Thank you, Amir. I think that's a really important question. I'll also just take a minute before we move on your presentation to just speak to how real estate agents are compensated as well. So the way that real estate is organized in Ontario is that when you hire a real estate agent to represent your interests when you're on the buying side of a transaction, you're going to enter into something that's referred to or legally called a buyer representation agreement. So you're going to interview agents. You're going to decide who you think is going to do a good job in representing your interests. And what I mean by that is show up in value with you to real information that you need to assist in your home search, give you real information with regards to home values and history and information on the house, and also to negotiate on your behalf with the seller or the seller's agent to try to get you the best deal possible. We are required legally to work in your best interest, but we are compensated through the listing brokerage of the property that you buy. So let's say, for example, we go out, we look at 25 different homes over the course of several months. You decide that one of them is the one that you'd like to put an offer in on. The compensation that we receive is from the listing brokerage for the seller, even though we are legally and contractually obligated to represent the buyer's interest in the transaction. So as a buyer, again, in almost all cases, there is no cost to you for having representation from a real estate professional. It's a big miscommunication. Sometimes people think like, oh, I'll just go into an open house and work with the listing agent and get a better deal. That is not correct. You have just entered into a multiple representation where you're asking the person who's been hired to get the seller the best deal possible, to try and ask them to get a good deal for you as well. It's usually not possible. So it's something to be mindful of. I'm happy to have a deep dive conversation with anybody that wants to discuss buyer agency or buyer representation. That's a high level explanation of what it is. We can go into a deeper dive of what that looks like. But if you're sitting here and being like, wow, all of this information seems really great, but I don't know if I can afford to pay somebody who knows their stuff like Omair, or somebody who has a base of knowledge that, 20 years of real estate experience has brought to Carol or someone on her team, please rest assured that in almost all cases, you are not paying for your representation. We're compensated through the person who chooses whose home you choose to buy. So hopefully that answers your question on that. Simon did rephrase his question about the CMHC premium. I just want to touch on it. He said if his down payment started at less than 20% and over time he's paid off 20% of the principal, does the CMHC premium drop off automatically? Simon, it was a one-time payment that you made at purchase. This is not a reoccurring payment that you pay all the time. So there is no requirement for you to continue to pay it. You pay it once and that's it. Hopefully that answers your question. Do you have another slide, Omair? I just want to touch really closely as we wrap up on the, and then there's also a question, what's the lowest variable rate on the market currently?
So the lowest variables that we've been seeing between 5.9 to 6.1. That's the lowest that we've been seeing. There's some really good questions. I'm just looking at them now. Do you want me to take
a few of them, Omair? Because we have anonymous. So again, I'd love to meet anonymous. And anonymous, maybe if you could just message me your name, just so I can make sure that somebody does a deep dive, because you're talking about multifamily units, owner occupied. This is a little bit more of an in-depth conversation that won't apply to most people on this call, and it's probably a half hour to an hour conversation. I don't want to overwhelm you by that, but there's a lot of nuance to that won't impact most of the people on this call. VTB, which stands for vendor takeback or seller's financing, essentially non-existent in our marketplace. Omair, have you dealt with a vendor takeback mortgage? I haven't seen one in 21 years.
Yeah,
Very rare.
Yeah, the only time we run into vendor takebacks these days is with pre-construction or builders. But I know what Anonymous is trying to say here. With creative financing and VTBs and assets and stuff like that. Yeah, I mean, you can be very creative these days with financing, as long as the way we look at it is there's a line, there's a legal and ethical line. As long as we're not crossing that, we can be as creative as possible, plain and simple. I'll go back to Anonymous here because they brought up a wicked point here. He was talking about RSP loans. What are the requirements and how do they work with debt to income ratio? So RSP loans are a phenomenal way for you to be able to get into the housing market. A lot of people don't know this, but you can actually go and get an RSP loan through the bank. The minimum down payment required for a $500,000 property is $25,000. Minimum down payment required for a $600,000 property is $35,000. Maybe you have some money, maybe you have all of it, maybe not. But you can actually go and borrow $35,000 today as an RSP loan, and the bank will give it to you. Generally, the bank will give you an RSP loan amortized over 15 years. BMO will, I know, because we do it all the time. The interest rate on RSP loans, super low, about 7.7%. Could be lower based on prime rate. Right now, prime is at 7.2. So you're looking at a 7.7% interest rate with RSP loans. But long story short, you can borrow $35,000 on an RSP loan, and your payment will be around $300 a month. You can now take this $35,000 that you borrowed from RSP loan, and you can take it and you can use it to buy a property, because you can withdraw money from your RSPs up to $35,000. So Anonymous, what you're talking about is a phenomenal idea. We've actually used this strategy with countless buyers, the ones that don't have a lot of down payment saved up, or the ones that are in process of saving up. It's one way of getting into the market. Sorry.
Thank you, Omair. And Anonymous has already reached out to schedule a call. So I think that's great. And just an important point, guys, if you want to connect with Omair, you're in this with the slide deck. We're also going to provide his contact information as well. So you can connect with him as well. A couple of questions that were emailed in ahead of time. And I just want to go through them because we had a whole bunch of them. Owner occupied, multiple family, less than 5 units. First time. Okay, you know what? That's going to be I think that was one of Anonymous's question. Is buying a cottage a great way to start as a first purchase? This is an interesting one because during COVID that happened a lot. And I know that we do our cottage buying seminar usually in the spring, and that's a very popular one as well too, Omair. I don't think we'll go down that rabbit hole, but it's to say, I think high level answer is that, you know, the first purchase that you make does not necessarily mean that you are going to leave your rental. And I think that's a really important one. You may continue to rent in the city and then purchase something that gets used as a primary residence, but it's outside of the city. And so maybe you're working from there 5 days a week, and then you keep a city place just for a place to come in and spend a few days a week. It doesn't necessarily replace a rental for all people. We do have many buyers who buy a recreational home with the intention to own or occupy that as their primary residence. And if so, that's something that's of interest to you, we can certainly talk about that on a one-to-one. First-time buyer programs, we talked a lot about that. Oh, this is a great question. If purchasing a pre-built condo, once it's ready for occupancy, at what point do you need to have an approved or a pre-approved mortgage? So a lot of people don't realize that in addition to resales where you go in and you go to an open house or you see stuff on MLS, we as agents have access to this huge wealth of literally hundreds of thousands of units that are currently available in the pre-construction world. So what that means is that we can put you in touch with builders who are looking to sell something that hasn't been built yet, and we can help you navigate that process. So if you see a condo tower being built in your neighborhood and you're curious about it, or a new townhome subdivision that you're interested in, please, as a first course of action, reach out to your real estate agent. As soon as you go into the sales center, most people don't realize, but you have, you forego your right to independent representation, and you indicate that you're working directly with the builder who is not bound by the same Real Estate Council of Ontario Code of Ethics that we are. It's not to say that they're going to treat you unfairly, but we are able to negotiate on your behalf. And like a resale, there is no cost to you. We are paid directly by the builder if you choose to buy one. But Omair, I think it's a great question. If you're interested in the pre-construction, when do you need to figure out your financing? Because you're buying something that may not be built for 2 or 3 years.
You know what? Nowadays, pretty much every single builder will require a mortgage pre-approval letter. And they want that upfront during that 10 business day cooling off period. So hopefully you're going to a bank or a mortgage broker who is reviewing your financial circumstances to make sure that you're not going to have any challenges for qualification at the time of closing. Now, having said that, I mean, this is all done on best effort basis, because if you're buying a project that's closing in 4 years or 5 years, many things can change, right? Your financial circumstances can change, but hopefully for the better, right? But the reality is that you may not require a mortgage at the time of occupancy because the building is not registered yet. So you're probably paying the builder whatever rent, if you want to call it. But when the building is ready, the builder will give you notice of final closing. And honestly, from what I've seen, it can be as fast as like 2 weeks, where the builder will come back and say, yeah, we're your final closing is in 2 weeks or 1 month. And at that time, you have to contact the bank, get your mortgage paperwork in order, get the mortgage instructions out to your lawyer. So in all honesty, if you've received occupancy for a property, contact a mortgage broker right away and get your mortgage sorted out so there's no surprises and you're not rushing. Like, we had a client who was in Mexico, and their lawyer emailed them saying, yeah, you've got a closing in 10 days. And the client is like, what are you, like, I'm here for 7 more days. Like, what's going on? So, that's not how you want your vacation to be interrupted, where, instead of you being, in the pool, you're now running around calling your accountant and looking for documents.
Thanks, Omair. And I think last question before, and I'm going to give both Caitlin and Sarah Copon a chance to just present you guys with a couple of properties super, super quick, but in 30 seconds or less. And actually, you know what? This may be a yes or no question. Do you need to be debt-free before you apply for your first mortgage? I love this question because there's so much misconception out there about this. Do you need to have student loan, car loan, credit cards? Can you have debt before you apply for a mortgage?
I mean, you know, there are unicorns out there, I guess, right? But the reality is that you know, a lot of people have debt. You don't have to be debt free. It's very difficult to operate without credit these days. You know, especially if you've gone to school, you'll have student debt. You need a vehicle, you'll have a car loan. So don't overthink this. Talk to a mortgage professional. Let them do the numbers. Because worst case scenario, we can come back and tell you that, okay, at this point, based on your income and debts, you qualify for a mortgage for 600,000. But if you want a mortgage for 700,000, maybe you have to pay down one of your credit cards, or maybe you have to pay down one of your loans. So no, you don't have to be debt free. Not many people are. That's just the way our society is right now.
I agree with you entirely, Omair. I'd love to turn it over to Caitlin and Sarah. We've just selected 4 properties that we have currently coming up. Everybody seems to love looking at real estate. It is so Dave, I'll get you to share the screen on those for our listings. Everybody seems to have a part-time job, which is searching the MLS while they're at work. I feel like House Sigma is a popular place to spend your afternoons when you should be at your desk doing other things. But just super important because I wanted to show people that there are real options under $1 million. This belief that you need to have $1 million to buy a house or a property. All of these are located in Toronto. And so here we go. We're going to go super quick through 4 properties. And Caitlin, you're going to take us through 2, and Sarah, you're going to take us through 2.
Awesome. Thanks, Carol. Thanks everyone for coming tonight. I know Amir had a lot of information to share. I'm just going to wait for Dave to get the slide up and running. So one really exciting listing of ours that just sold was 121 Botany Hill. This is just located in North Scarborough. Was listed for $899. Sold last night, but it's a really great condo alternative. This, as Carol mentioned, was a property that was purchased by a great buyer. First time buyers, they were putting down less than 20%. They got, a steal of a deal here. In a, ever evolving market where it gets really busy. This is a 3+1 bedroom, 3 bathroom with 2 to 3 parking spaces included. And as you can see, it was quite renovated, but, mid-century modern home.
And ravine lot, this backed onto the ravine.
Yeah, really great property.
We didn't have a picture of the backyard in this presentation, but it was an amazing ravine property and close to transit. Sarah, you're going to talk about our next one on Glen Everest.
Yes, this is unit 415 on 90 Glen Everest. It's listed at $509,900, and this is a fantastic option with great appreciation potential at an amazing price point for anyone looking to get into the market. It's located in Cliffside. It is a 1-bedroom plus den unit with great building amenities. It's got a rooftop terrace with panoramic views, a gym and party room, just to name a few. And by the way, we do also have other 1-bedroom and 2-bedroom units available in this building. So if you're interested, you can reach out to me or the agent that invited you to this webinar.
And this one, Sarah, the builder is actually, because this is new construction, and the builder is actually offering free maintenance for a year, which is a value of over $6,000. So if you're concerned about your monthly payments until until the interest rates start coming down, it's a great way to take $500 off of your monthly expenses. So great option. And again, we have several floor plans and unit sizes available in this building, starting at, I think, at the mid 400s. There's some really well priced units. And then we're going to go out to Ajax for our next one.
Oh, yes, this is 50 Berkshire Road. It is situated in a quiet, family-friendly neighborhood in Ajax, close to school and all the amenities. And what I really like about this property is that it has the income potential. It has a 2-bedroom basement apartment to help offset some of that mortgage cost. And so you have a 3-bedroom upstairs and 2 bathroom and 6 parking spaces. So great option. if
And
they're
I think,
looking to
Sarah,
get into
really,
the market.
yeah, really important to note with something that has a legal basement suite like this one does, rentability of this basement apartment, we think it's how much, Sarah, of this 2-bedroom basement apartment?
You're probably looking at somewhere in the 1,900, 2,000 range.
So if you're thinking about the fact that your housing costs, are only going to be between, $4,000 on a property like this, 2,000 of that would be paid by the tenant. And then as your family expands or your need for space expands, you can always take over that basement apartment and occupy itself. But it's a great way to really get your housing costs down. It carries less than rent. So this property is currently on the market. If you're interested in seeing it, please just reach out. And then Caitlin, you're going to take us downtown. We're a little bit closer to the downtown. This one's one we've got coming up.
This gem, it's coming soon, as you can see, not yet on the market, but it is a 2-bedroom, 2-bath in the pocket next to Leslieville and the Woodbine Corridor. It's fully renovated top to bottom. There is parking. It's not yet prepared yet for showings. However, if you do want to take a look, feel free to reach out to any of the agents on this call that might have invited you today. List price is $929 as well. So I think a lot of people have this idea that, you can't buy close to the city and near by the water. There's a lot of mom and pop shops over here and everyone's quite friendly. It's a very family friendly neighborhood.
Amazing. Well, thank you guys so much. I want to thank everybody for hanging in. I know it was a lot to unpack tonight, so much information. Hopefully this is the start of a conversation that you will have with, your real estate professional, with Omair, and with the people that are going to be decision makers in this process along with you, whether that's a partner, a parent, or really just a hard conversation with yourself about whether or not this is the year that you're going to get into home ownership. There are 39 of you that held on to the end of this call. I'm grateful to you, and there will be hundreds more that watch it and repeat. We had a tremendous, tremendous outpouring of interest in this particular one. There are people on this call tonight who are going to take action, take next steps. And this time next year, we'll receive an invite to a first-time buyers seminar and perhaps watch it or share that seminar while sitting in the living room of their own home. And so it's a great honor to be able to work along this amazing team of skilled professionals that are just so excited to be able to take this journey and this next step with you. So if you feel like you're ready, or you feel like you will be ready once you have some more information, please rely on us to be able to share that with you. And we are just so excited for the opportunity to be able to share our knowledge with you. So I'll thank you all for logging in tonight, and we will announce the winner of our IKEA gift card as well in the announcement. So be sure to check the link when you get it sent through to you. And again, you'll be receiving an invite to our Wills and Estate Seminar, another really, really popular one that we'll be hosting in mid-July. So thank you, everybody, for checking in with us, and we will catch up with you again next time. Take care, everybody. Good night.